So that last panel was actually the perfect lead-in for this panel right here. I mean, talking about ending it with how real estate is probably going to be the predominant industry within crowd finance. So that's perfect that we have with us here today three leaders in that space. And I just thought really for this panel, I mean, first of all, I think what you guys are doing just in the Reg A space and Reg A, well, I can't say Reg A plus, I'm sorry, the Reg A space. We're seeing so much innovation. Nick is here from Ground Floor, you know, really one of the pioneers in the space to utilize the Reg A to actually create a new type of fixed income instrument for the masses. George, same thing with AHP. And, you know, what I thought would be a really good idea for this really to really just kind of focus on you guys and really just kind of introduce yourselves, introduce your platforms, talk about the products that you're providing. I mean, talking about, we do have this major distribution problem. Part of what we need to do is educate the masses. We have an incredible opportunity here with the cameras and with the broadcast to actually, you know, go out there and kind of teach people what this is all about. And, you know, and being that some of your products really are geared towards retail, to talk about a little bit about that and how they could access them, what they could kind of expect. And then we could talk a little bit, you know, on the industry sides, kind of what the process has been for you guys in utilizing some of the legislation to make real estate available to people. So, want to start? Want to start with George? We'll start and go down. Okay.
My name is George Newbery. I am the founder and CEO of American Homeowner Preservation, and we market investments backed by real estate, but it's a little bit of a twist. What we do is we utilize Regulation A+ and raise money from investors, and that money is used to buy distressed mortgages from banks and other lenders. And these are primarily in low to moderate income neighborhoods across the country. We've bought in all but 2 states in the contiguous U.S., which is Wyoming and North Dakota, and we bought in Alaska and Hawaii and Puerto Rico. And the typical profile of a loan that we purchase, a homeowner owes $100,000. The home is currently worth $50,000, and we can probably buy that loan for $15,000 to $20,000. In many cases, those loans are 2 and 3 years behind. And it may seem odd because there's been a lot. The real estate market has improved a great deal over the last several years, or last 3 years or so. But in the low and moderate income neighborhoods across the country, many of them have been left behind. And in fact, there was a study done by Realty Track last year, and every price category of home, real estate, had increased. There had been appreciation from $50,000 on up, $500,000 on up, $1 million on up. The only sector which was still losing value was those homes with values of $50,000 and less. And that is a huge problem. It's partially thanks to Dodd-Frank, which restricted lending, made it very unappealing for new loans to be originated in these neighborhoods. Despite the record low interest rates, many families who can qualify to live in these neighborhoods, they just can't get loans. And so what they do, or want to buy a home in these neighborhoods, so they're counseled to buy in slightly more affluent neighborhoods, and it just leaves these neighborhoods behind. And it's a huge problem, which I think is still, you know, foreclosures are out of the news, but there's still millions and millions and millions of families who are underwater by drastic amounts. And that's a problem we're trying to solve in a very small way. We buy these loans from the banks and lenders, and then we go to the families and offer them solutions, share some of the discounts with them. If they want to stay, we can offer them a financially transformative modification. We'll drop the principal. We will reduce. Again, at this stage of the cycle, these families are often 2 and 3 years behind. They may owe $20,000 or $30,000 in just delinquent payments on a home, which in some cases is only worth $20,000 or $30,000. So we'll offer to take $2,000. We'll forgive the difference. We'll drop their payment. You know, if it's worth $50,000, we'll drop their payment to $500, and that's the same payment for the remaining term of the loan. It seems charitable, and actually we started out as a 501c3 nonprofit in 2008. We've since transitioned to for-profit. But it's also financially rewarding. We can generate very good returns for our investors, and that's all a result of the discount that we achieve when we buy these loans from the banks and the big hedge funds. There is a lot of the big hedge funds who are buying these loans and have driven the prices up in the more affluent neighborhoods. It hasn't happened. They don't want the ones in the low-income neighborhoods. They really see these as problems. And they can say, hey, great, George, your company's making $10,000 on this deal. It's not worthwhile for them to focus their resources. But if we can make $5,000, $10,000, $15,000 on these loans and do hundreds and hundreds of them, then I think we've created a niche business, which is what we've done. Now, we started out in 2013 raising money online using 506C, which was great. It allowed us to broaden our base of investors. One challenge that always felt a little distasteful was that the only investors who could participate were the rich. So it was kind of the rich helping the poor, which I guess seems nice, but you know, we could help a homeowner, and then they could not kind of pay it forward by helping another homeowner. They had to keep their money in the bank or some modest, generally modest returning investments. So Regulation A Plus, from a social justice perspective, I think has been fantastic for us. Anyone, I mean, truly we can say anyone can invest. And it's opened the market widely. And we have people who invest $100. Our minimum is $100. People invest $100, $1,000, $100,000, several $100,000. They could be non-accredited, accredited, or even some small institutions that invest with us, and they're all getting the same deal. And I think that's unusual, and I think it's important. And that's something that I think helps our mission from all sides. It's something where we're providing an investment opportunity that's understandable and something that has a significant social impact, and also is helping families across the country. And we're generating high returns. I still don't know if I can. We filed our audit last week, and I don't know if it's publicly available on the SEC. We generate very solid returns. In our first year of Regulation A Plus, 2016, we were operational under Regulation A Plus. I keep saying A Plus. Regulation A improved for 6 months, and we did file our audit on time last week, which is stuff that we're still getting used to, but it I think proved out our financial model is working, and we're able to deliver not only financially transformative solutions to the families that we help on their mortgages, but also reasonably positive financial returns to the investors. And some investors are really surprised by what we do. And again, it's not off the backs of the families that we help. It's all because we can buy these loans at such huge discounts from the banks, because they really are. We're buying what other funds do not want. And so that's, regulation, it came up earlier, and actually Mark kind of commented on how important it is to focus on investors and their experience. I mean, it's hey, this would be great for us to have the ability to raise $50 million. This would be great for us to do all this online. But how can we improve their experience? And it's something we've been very focused on. And we always think, hey, this would be great. Let's do this. Let's be great. Do this. And then it kind of, between legal and technology, we try and keep everyone get caught up. But here are things that we've done that we've seen good response from our investors on. A lot of them, traditionally, we distribute returns on the 10th of each month. A lot of investors say, hey, I don't want the return, can I reinvest? So we've created automatic reinvestment. And so they can select to reinvest their investments, their gains each month. We have some investors say, hey, can I invest $100 a month, or $100 twice a month, every payday, or $500, whatever the number is. And now you can choose. You can invest on the 5th or the 20th, or both. And those have been very well received by investors. Financial advisors or investment advisors, that came up earlier as well. And I think it is a problem. We have investment advisors who are counseling their clients to invest in AHP, which is great. But it's a hassle to invest with us if you are an investment advisor. And I think we've identified the problem, and we're close to working a solution. I'm hoping we're solving the right problem, and I guess we'll find out pretty soon. So our feedback from investment advisors is two things. One, they don't want to tell their client to go and invest on our site. They kind of lose control. They want to be able to go onto our site and initiate the investments, and they can 20 of their clients or 50 or 100 of their clients on there and create the investments and then simply initiate an email to the investor to sign the account, to sign the investment agreement and invite them to come and they've set up a login so now that investor can come in and see their account. And that functionality is almost built. It should go live sometime this month. And I think that will be great for the investment advisors and their clients. Another thing, and this is probably the biggest problem that we've identified, is most of these investment advisors have a platform that they utilize to track all their investors' investments. And it's one of the big, I imagine it's Schwab for most of them, and then there's others. And particularly for impact investing, and maybe it's more general, but we've identified a platform which is called Advent Black Diamond, which a lot of investment advisors that we work with are utilizing. And so we created a data feed, and it hasn't gone live yet, but again, should go live this month, which will provide data on our fund to these investment advisors. And why is that important? Now, instead of having to have an investor with 20 investments that are all available on one screen and then AHP off to the side when they have to calculate their fees and whatnot, it's a hassle, they tell us. And I imagine it is. So now we will be side by side with whatever other investments that they have. And I think that's a big step towards solving that problem. Also, final one is IRAs. IRAs are still manual. If someone wants to invest in their IRA, they have to go offline. We have to email the subscription agreement. It comes back. Each custodian seems to have a different set of documents that they want signed. And so it becomes a manual process. It's great because we have a lot of IRA investors, but it's a hassle. So we're close, again, we always seem close, but it's close to an integration with IRA services, which will move that process, take it out of manual and make it as automated as we can. And also we've agreed for the investors that utilize IRA services will pay with some qualifications, such as a minimum investment, maintaining a minimum investment of $5,000, we'll pay their fees, their transaction fees and their annual fees. So it's an incentive. They can still use any custodian they want, but if they use a different custodian where we have to go manual, we're not paying their fees. So hopefully it's an incentive so it drives automation as much as possible to this process, because again, we are accepting $100 investments, and as someone made a comment earlier, that is, you have to make it automated or it's really not profitable. And the reality is, even though it is automated, a $100 investment probably still isn't profitable for us anyway. But it is, we repeatedly see this, and this is what we expected. An investor will start out with $100 or $1,000, and then a few months later they say, hey, this is working, I'm getting my reports, everything looks good. Now they're putting in $10,000, $50,000, $100,000, and it's almost, to our perspective, the $100 minimum investment is marketing, and it's just, $100 for many families is dinner and movies on a weekend, so I can probably risk that and see how it works out. So that's the other side of that's the investment side of the business. The other part is we still have to buy these loans, and it is, the market has continues to strengthen in many markets across the country, the real estate market, and concurrently with that, you see the demand for these real estate mortgages going up. And again, we have this niche, which is the low and moderate income neighborhoods, so the pricing has remained attractive there. We can still generate good returns, but there is, to do big deals right now, we're just priced out. We can't compete. The other people are willing to pay a lot more money than we are, and we've been disciplined in trying to find deals on the margins, which also generate the margins that we need. And I'll give you a couple of examples. In March, we bought 477 loans. It was a dispute between a lender and their financer, and they were in court. Eventually, there's a court-ordered sale. There was a bid of $990,000. That was our bid. Another bid for $1.7 million. We were able to take the deal as is, no contingencies, and so they took our lower offer, which was encouraging. And so now we're working on those loans. There's a bid right now that we're working on for 799 loans, which we hope to close this month. It's a lender that's in bankruptcy, and our bid's due next week. I think we're going to be highly competitive. A lot of low-income neighborhoods and a lot of document deficiencies, and you hear these tales about families in foreclosure, and they say, hey, show me the note, or or the bank's missing the file. And people think, oh, that's just speculation. The reality is, it's true. We buy these files from the biggest, they originated at Bank of America, Wells Fargo, and Chase, and by the time they get to us, these files are in tatters. They are missing the note. They're sometimes missing the complete file. There's nothing. And we can buy those. Obviously, we price that into our bid, and we can buy these at huge discounts because the risk is, hey, this could be a legal battle. But if we buy a $100,000 mortgage secured by a home that's worth 50, and we normally pay 15 or 20, and because there's no file, I can buy that for 5. Now, there's no reason to litigate that. I can go to that family and say, hey, I'll drop your payment to $250. I can make an exceptionally attractive deal to them, and why fight? Let's just make a great deal from the outset and move forward. And that's what we do. The reality is, for whatever reason, the majority of banks and services in this country do not do that. We make our deals, we offer our resolution at the outset, and it's something which seems so easy, but it's just not common. And I'll tell you, so if I'm in default on a mortgage with Bank of America, I'm told to do this. I'm told to call Bank of America and say, hey, I need your help, which seems ludicrous. And then Bank of America is going to say, well, okay, we want to help you, which is also a lie. And they're going to say, okay, give me your tax returns, your paycheck stubs, your hardship letter. Tell us why you're behind and having trouble with your mortgage, and all these other documents. It's almost like I'm going through a new loan process. And so then I go back and forth. And now picture a family who maybe some of their money comes from babysitting, or they drive Uber or something like that, and they don't have great records of all their sources of income. And now maybe we haven't filed tax returns in a couple of years. And so now, then Bank of America's going to say, well, we can't get a mod. Or best yet, you have everything, you send it to them, and then 60 days later they say, oh, we lost everything, we can't find it, it's outdated, replace it. And these are all completely true. You'll hear them in the news, but it's absolutely true. So we do away with all that. We don't ask for tax returns, bank statements, hardship letters, paycheck stubs, nothing. If we buy your mortgage and you're in default and we just bought it and we think that home is worth 50, we will send you a letter saying that your payment was 800 and now we'll drop it to 500. You haven't paid in 3 years, you owe 20,000, give us 2,000, we'll forgive the difference. Your principal was 100, we'll drop it to 50. Again, and if you don't want to stay in the home where it's already vacant, we'll give you $1,000. You sign the deed in lieu, we forgive the difference. And we also, if you happen to have the cash, or you can somehow pool together the cash, come up with $45,000, and we'll settle the loan in full. And that's done as soon as we board the loan. So they get the terms, and people will call. It literally happens that people call in and say, I want option number 1, I want option number 2, I want option number 3. It seems so easy, yet it just does. It's not what the servicers do. So that's what we do. We've tried to streamline the process and make these resolutions viable. Ideally, at some point, it'll actually be practicing what we're doing with investors is say, okay, you want to do one of these options, go online and you can electronically sign your mod, or you can schedule a time with a notary to sign a deed in lieu and they'll bring you a check, or we can deposit that incentive to your bank account. These are things that hopefully happen over time in order to maximize the efficiency. But it's all about efficiency. Again, making $10,000 100 times or 1,000 times, what does it cost for you to do that? And if we can drive those costs down, minimize the cost of litigation, because the number one expense for us, despite our absolute focus on consensual solutions, is still litigation. The legal expenses, as bad as Bank of America, Wells Fargo, and Chase are, their attorneys are even worse. These law firms, present company excluded, if any of you have clients who are these big banks. But it's a paradox, and it doesn't make sense. If you are a firm, a foreclosure mill, a firm that focuses on foreclosures, here's how it works. Bank of America or some lender will give you a file, and if you can achieve a quick prompt resolution, if that attorney can achieve a resolution, that attorney or law firm makes almost no money on the file. So there's this perverse incentive that you want to see this, the law firm wants to see this file go as long as possible, generate as many billable hours as possible, and us as the client, we want to resolve this as fast as possible and want to have as few billable hours as possible. And it's odd, the lenders, Bank of America and whatnot, it just seems they don't focus on it. And oftentimes they're just the conduit for some mortgage-backed security, so no one seems to really care. We do care because it directly impacts our returns. So we've really focused on how do we reduce these legal fees, and it became so impossible. No matter which law firm, I shouldn't say, there were a handful of law firms that we actually to make reasonable deals with, and they would kind of focus on resolutions, but it never seemed consistent. So finally, last summer, I got so frustrated because the last 2 years we spent more than $1 million a year on legal fees, and sometimes it's as simple as the homeowner's deceased, there's no estate, we need to foreclose on this property. And so what we did was I discovered on the internet that in Washington, D.C. is the only place in the country that a non-attorney can be a partner in a law firm. So I thought that was novel. So I actually partnered with a Washington, D.C. attorney, and now I am a non-attorney partner in a law firm. And what we do is we offer legal services to creditors such as AHP and others, other like-minded funds, which there are a few, and we actually incentivize the attorneys that work with us, and we're in about 10 states, almost 10 states right now. The attorneys receive an incentive to resolve these files. If they can work out a resolution with the family, that's where they make the most money. They make the least money if it goes all the way through and there's never a resolution. So it's still early. We just started that in February, but it is, I think, I'm giving you these anecdotes of what we've had to do. And I think it's what this crowdfunding industry is doing is, as you kind of identify what you perceive as problems, let's try some solutions. And certainly, I share some that have worked for us, but there's certainly some that we've tried and they just haven't worked. But I hope that gives you some insight into what we've done. Regulation A+, for us, we think it's wonderful, social justice-wise. We attracted a significant amount of new investors, and I think that'll only scale. So we're excited.
Can you
about it.
say what your returns are, or is your attorney not allowing you to do?
Yeah, you can say what was in the
Pass.
financial statement.
Okay.
File.
Okay.
Public information.
Okay.
He's going to have another solo presentation to give over this.
Oh, okay, okay.
Well, I can tell. You kind of all the
We're gonna leave
build-up.
you all in suspense, I think.
Let's keep about that. We got to get going. So
Okay.
let's ask
Okay, so
another
we'll go down the line.
panel.
Yeah,
He's gonna have
Alan, you got the stage.
At 2 something, he's got to have a private solo presentation. So
I'm on pins and
Sorry,
needles.
Lisa.
Suspense is always good, though. People are going to come back now. So my name is Alan Shayanfekr. I'm one of the co-founders and CEO of ShareEstates.com. We are a marketplace lending platform connecting individual retail investors, accredited investors, and institutions with real estate developers and sponsors that are looking for private financing on their transactions. Little background on us. I started the company back in 2013 with 2 partners who've been in the real estate industry for about 15 years. Initially on the title insurance side of things. They started off as developer speculators themselves. Moving into my background personally is actually on the legal side. I actually graduated law school back in 2012, came out and started working on share estates right out of that. Right around 2012, 2013 was when the marketplace lending industry really started to take off. So my partners and I had looked into the industry and said, hey, what Prosper and Lending Club and some other companies are doing in different verticals is essentially what real estate syndication is the old-fashioned way. So why not add a technology component to it and make it its own platform? And in 2012, the Jobs Act, came about, and the regulations and rules started changing to permit such a platform to exist. So we actually went into our beta launch in July of 2014 and our full launch in February of 2015. Since then, over the last 2 years, we've gone on to fund about $450 million worth of transactions, primarily with a debt focus on the East Coast, averaging about $800,000 per project, anything from about $100,000 to $5 million. And essentially what we did is we identified a missing piece in the industry for private developers that needed access to quick funding for their investments, traditionally called hard money. So these are guys, speculators, developers that are going out, buying properties at a discount, off-market transactions, where the property is in a phase that is not going to qualify for bank financing. And I remember when we first started in this industry, there was a huge misconception that, hey, if you're going to invest in a real estate crowdfunded deal, it's going to be a subpar deal. It's going to be people coming to a platform that, can't get funding from a bank or can't get funding from another source. And the reality is that that's not true at all. Hard money lending, private lending in the real estate industry has been around for decades, and it's just been a very inefficient, compartmentalized industry where you had small mom and pop type lenders that were, turning over 20, 30, 40 million dollars at a time, but ultimately couldn't get to any meaningful scale because they didn't have the technology, they didn't have the tools that they needed to do so. So over the last 2 years, we've focused on a couple of different initiatives. We do have a retail component to our platform where we allow accredited investors to participate. That today represents about 15% of all the funding on our platform. We also work with a number of institutions. Altogether, we've brought in about $2 billion worth of capital commitments from our funding partners. So we're on track right now to originate about, I'd say, $750 million to potentially $1 billion this year in new origination volume. The company is growing in a healthy way and steady way. Investors on our platform are averaging about 9 to 13% annualized returns with monthly distributions. We haven't experienced any loss of principal to date for any of our investors, and we really think that we're filling a hole in the marketplace. We actually just put out a press release earlier this week about a new tool that we're making available that we're calling the ShareLine solution. And essentially what we've done is, or what we're going to be doing is white labeling our software and providing that technology that these mom and pop shop lenders have been missing on a more localized basis to people that know their markets, know how to originate in those markets, and then provide them with a centralized underwriting system. So not only will they have the tools that they need to better service their clients, give their borrowers access to log in and set up things like auto pay, request payoff letters and whatnot, and also handle their draw process, but they'll be able to actually lower their cost of operations by feeding all of their loans through into our centralized underwriting system so that we can still control and maintain quality of deal flow that we're making accessible to our investors while scaling up our own operation. I'll leave it at that because I don't know how much time we have left, but I'll answer any questions that anybody has afterwards.
That's great. Nick?
Thanks. Hi, everyone. My name is Nick Bargava. I'm a co-founder of Ground Floor, and much like the share states, guys, we compete against hard money lenders, but we're in a different segment of the market. Ground Floor originates loans for single-family and small multifamily fix and flip projects, new construction, etc. We've lent to everyone from weekend warriors to builders who do maybe 400 houses a year, subdivisions, master plan communities, etc. But our bread and butter is mainly the fix and flip deal. Average loan size of about $100,000, average term of about 9 months, and we exclusively raise capital to originate these loans from non-accredited retail investors through our online platform, much like Lending Club and Prosper. And we reached those investors by using Regulation A. We actually had the first Reg A deal qualified under the new rules in August of 2015, and have been going strong on that model ever since. So that's the short and sweet of it.
Could you tell what returns your investors are?
Yeah, right now investors are getting an average annualized return of about 13.6%. So it's been consistently around 13-14%.
And I think, $25 minimum?
It's debt. It's debt with a $10 minimum. That's right. So
$10 minimum. Wow.
yeah, it's very much focused on the non-accredited retail investor, much in the same vein as Prosper and Lending Club when they first started, before institutions became an increasingly important part of their capital stack.
And one thing that you could talk about too that I think is really interesting about Ground Floor is that Ground Floor has a really unique regulatory roadmap. Just in your history, you started off actually using the Invest Georgia exemption.
Right.
Moved the company to Georgia to take advantage of intrastate crowdfunding to test it out. If you want to tell them.
Yeah,
that.
so to see if this model was viable, and before we invested in undertaking a Reg A offering, we decided to use an intrastate crowdfunding regulation in Georgia called the Invest Georgia exemption. At that time, there were only 2 or 3 states that had intrastate exemptions on the books. It was Kansas and Georgia, and I think at that time maybe one of the Midwestern states that was in Kansas.
The Kansas was the first, Georgia was the second,
Yeah.
but Georgia was the first actual one to actually get done.
Yeah. It's a really flexible exemption, I mean, it's a two-sided piece of paper. You file it with the Secretary of State, and away you go. But it gave us the flexibility we needed to actually go out and test the product in a market, make changes to the product, and the local market in and around Metro Atlanta responded really well to it. And from there, we built the company out using Regulation A to expand to other jurisdictions.
So how many states are you in now?
We're in 9 states. We're currently selling our investment product in 9 states, and we're lending 50 statewide.
I've recommended your offering to a friend of mine with his self-directed IRA,
Thank you.
and I just wondered, what is the liquidity of the shares?
So what you're buying is what we would call a limited recourse obligation. It's similar to a lending club payment dependent note. You're holding it to the term, and the average term maturity is 9 months. We're selling a 12-month obligation, but most of these projects finish up and repay in 9.
And you've had no losses, I think.
Well, we before we really ramped up, we sort of had that feather in our hat, but we've had a little over a dozen defaults. One deal actually lost principal. One deal we returned full principal, but weren't able to recover any interest, and the rest have been either full interest recovery or some modification and a reduced interest recovery.
Percentage of defaults, would you say, overall?
That represents less than 5% that have actually defaulted, and then in terms of loss of principal, it's 0.5.
That's great. So would you guys say that, you know, that this, how would you say, and I guess this will be the final question because I know we're going to break for lunch, but just as far as how has modern securities legislation, and from what you guys have been using, you know, Reg A and the new 506C and getting out there and how has that really changed the real estate industry? Is this the future of real estate? Do you think everything moves online now at this point?
Yeah. So when we actually first launched our platform in beta back in July of 2014, we actually conducted a Regulation A offering also for a pre-identified ground-up development deal in Brooklyn. Back then, I think the only other companies that had attempted it were Fundrise, and I think Ground Floor had also put in a filing at that point. You know, we went through what was an 11-week qualification process before we realized, hey, you know, we got through this one deal, but it wasn't going to be workable in a scalable way for us if we're going to have to pre-identify each project prior to raising capital. I think since then we've personally pivoted to a Regulation D model and started with what was a 506B model, and then later shifted to 506C. But to kind of echo what Brian Korn was saying earlier. You know, we've seen a lot of platforms start off in the 506C sector, but then eventually pull back. And, you know, I think it ultimately depends on which platforms you're talking about and how much feedback they're getting from their investors. But it is a bit of a nuisance to have to go back to your investors who have been participating with you and constantly ask them to update their records with you. You know, you're talking about an investment that's relatively secure. You know, people are making, you know, those 10 to 12% annualized returns, but when you start having to include additional fees from an outside vendor that is going to approve verify your accreditation status, such as your accountant, your CPA, your attorney, whatever it might be, it starts to kind of eat into that return and make it less attractive. So I think one of the things that, you know, we're going to be figuring out internally is whether we continue with 506C or switch back to a 506B model. But to kind of answer your question more simply, I think, yes, the future of real estate is going to be online. It's just a more efficient process as the technology develops and people start to understand what our industry does and is educated about it, that they'll feel more comfortable investing online. And slowly but surely, that retail side of the business will start to grow and catch up to what the institutions are doing today. It's just like anything else, and you know, that's changed over time. Commodities, trading gold, trading, you know, really anything else, futures. At some point, they were an inefficient marketplace, and technology fixed that. Real estate seems to always be the slowest industry to change with it, but it's happening now.
Okay. Any other questions? Okay, great. Thank you, guys. I do want to just say one thing, George. It was really interesting what you said about, you know, the $100 minimum. It's a great. I didn't even think about it, but even just what a great using micro investing just to be a lead generator. I mean, you know,
Great.
it's
They're now getting
it's
monthly
really
reports,
that's
they're
really
getting-
interesting.
they're
Yeah,
part of your base.
bring them into the industry like that. All right, thanks everyone. Let's enjoy some lunch.
Thanks, everyone.
Oh, this is yours.